This is 50 Habits of Successful Traders. Please watch full video to end. You will understand those 50 habits, and follow all those habits you will become profitably trade. Welcome again to my channel. Please subscribe to my channel and watch full video habit 1. Meticulous planning before trading. Plan your trades. Carefully. Successful traders don't make trades on impulse. They carefully plan each trade by looking at the market, figuring out the best time to enter and exit, and knowing how much they could gain or lose. Planning also means understanding why you're entering the trade, what the market conditions are, and what could go wrong. This includes deciding where to place stop losses, how big the trade should be, and the profit you expect. Example, Warren Buffett, although an investor, studies a company's finances, industry, and strengths before investing. Traders like Tudor Jones also plan their trades with clear goals to make sure every trade is deliberate and through. Implementation. Before trading each day, write a detailed plan. Ask yourself, why am I taking this trade? What profit do I aim to make? How much loss can I accept? What conditions would make me cancel this trade? What are the possible risks, and how will I handle them? Meaning, planning trades carefully reduces mistakes, prevents emotional decisions, and increases the chance of success. It turns trading from gambling into a controlled, thoughtful process. Habit 2. Practicing patience. Practice patience is one of the most important qualities that separates successful traders from those who fail. In trading, impatience can lead to entering trades too early, chasing losses, or making decisions based on emotions rather than logic. Practicing patience means waiting for trades that have the highest probability of success, adhering strictly to your strategy, and avoiding impulsive actions. It also means allowing your winning trades to continue growing, rather than closing them prematurely out of fear or anxiety. Example, Irving Kahn, a longtime student of Benjamin Graham, exemplified patience throughout his career. He carefully studied investments and was willing to wait years for the perfect opportunity. This approach allowed him to make highly profitable decisions and avoid unnecessary risks. Similarly, in active trading, waiting for the ideal setup helps prevent losses caused by chasing low-probability trades or reacting to short-term market noise. Implementation. To develop patience in trading, focus on the following steps. Sit on the sidelines until all your setup criteria are fully met. Avoid entering trades because you feel the market might move. Keep a detailed journal of trades you skipped, noting why you avoided them and what the outcome would have been if you had taken the trade. Review your journal regularly to reinforce the value of patience and build confidence in your decision-making. Practice mindfulness techniques or meditation to reduce emotional impulses and enhance focus. Meaning, patience allows traders to make thoughtful, calculated decisions and reduces the likelihood of emotional mistakes. It transforms trading into a disciplined, long-term strategy rather than impulsive gambling. Developing patience builds confidence, encourages strategic thinking, and helps traders maximize profits while minimizing unnecessary risks. Over time, patient trading leads to more consistent and sustainable results, demonstrating that success in the markets often comes to those who are willing to wait for the right opportunities rather than chasing quick wins. Habit 3. Master rigorous risk management. One of the most critical habits for successful traders is managing risk effectively. No matter how confident you feel about a trade, you should never risk a large portion of your capital on a single position. Typically, professional traders risk only 1 to 2% of their total capital on any trade. This ensures that a few losses do not wipe out your account and allows you to stay in the game long enough to benefit from profitable trades. Preserving capital is more important than chasing quick profits because without capital, there is no ability to trade and profit. Example, Ray Dalio, founder of Bridgewater Associates, is famous for his emphasis on diversification and risk parity. He spreads risk across multiple investments to ensure that no single trade can significantly damage the portfolio. Top traders employ strategies such as stop-loss orders, proper position sizing, and hedging techniques to protect themselves from unexpected market movements. Implementation. To practice rigorous risk management, follow these steps. Determine the maximum percentage of your total capital you are willing to risk per trade. Calculate potential loss before entering a trade and set appropriate stop-loss levels. Adjust position sizes according to market volatility and your risk tolerance. Use hedging strategies or diversification to reduce exposure to any single market movement. Stick to your risk rules consistently. Do not allow emotions to override them, even when a trade seems certain. Meaning, rigorous risk management protects your trading capital, ensures survival during losing streaks, and allows for long-term consistent growth. It turns trading from gambling into a disciplined, calculated activity. By controlling risk, you can focus on opportunities and strategies that offer a favorable risk-reward ratio, ultimately increasing your chances of long-term success. Habit 4. Maintain emotional discipline. The markets are full of ups and downs that can trigger strong emotions such as fear and greed. Many traders make costly mistakes when they let emotions guide their decisions. Successful traders, however, maintain emotional discipline, staying calm and rational even during market volatility. They follow their trading plan carefully and do not react impulsively to short-term market noise. Example: Stanley Druckenmiller, a legendary trader, emphasizes that controlling emotions is crucial for long-term success. Decisions driven by fear or excitement often lead to large losses or missed opportunities. By mastering emotional control, traders can make clear, rational decisions that align with their strategy. Implementation. To strengthen emotional discipline, consider the following steps. Establish a daily routine that includes mindfulness practices such as meditation or deep breathing exercises. Keep a trading journal to document emotional states before and after trades. Use visualization techniques to rehearse calm decision-making in high-stress situations. Before placing any trade, ask yourself, am I following my plan or am I acting on emotion? Review past trades to identify moments where emotion led to mistakes and develop strategies to prevent repeating them. Meaning, maintaining emotional discipline ensures that trading decisions are consistent, rational, and aligned with your strategy. It prevents impulsive actions that can lead to significant losses and allows traders to navigate volatile markets successfully. Over time, emotional control becomes a competitive advantage, enabling consistent profitability. Habit 5. Commit to continuous learning and adaptation. Successful traders are lifelong learners who constantly seek to improve their knowledge and skills. They study market behavior, explore new trading strategies, and learn from both successes and mistakes. Adaptation is essential because markets are constantly changing due to technology, global events, and economic shifts. Staying informed and flexible allows traders to maintain an edge. Example: Paul Tudor Jones dedicates time to reading history and economics, applying the insights to his trading decisions. Warren Buffett reads hundreds of pages daily to refine his understanding and improve investment strategies, demonstrating the importance of continuous learning. Implementation. Allocate at least 1 hour each day to study the markets. Analyze your past trades, read financial news, research reports, and books. Reflect on what you learn and integrate it into your trading approach. Keep track of new strategies, ideas, and lessons to ensure ongoing growth. Meaning, continuous learning and adaptation keep traders ahead of changing market conditions and help them make informed, strategic decisions. It develops analytical skills, foresight, and resilience, which are critical for long-term success. Habit 6. Keep detailed records of your trades. Maintaining a trading journal is essential for understanding your performance and improving over time. Successful traders record entry and exit points, the reasons behind each trade, their emotional state, and the results. Reviewing these records helps identify patterns in both mistakes and successes, which is crucial for refining strategies. Example: Jason Zweig, a financial journalist, emphasizes that journaling allows traders to spot recurring errors and improve their discipline. It turns experience into actionable knowledge and helps prevent repeating the same mistakes. Implementation. Use a spreadsheet or notebook to document every trade. Note what worked, what didn't, and the reasoning behind your decisions. Regularly review your journal weekly and monthly to extract insights and refine your trading approach. Meaning, detailed record-keeping transforms trading from trial and error into a structured learning process. It promotes accountability, self-awareness, and strategic growth. Habit 7. Focus on quality over quantity. Successful traders prioritize high-quality trades rather than trying to trade constantly. Overtrading can lead to emotional stress, poor decisions, and unnecessary losses. Focusing on quality ensures that each trade has a higher probability of success and aligns with your trading plan. Example: Richard Dennis, the turtle trader, stressed that you don't need to trade every day. The key is to identify trades that meet strict, high-probability criteria and wait for those opportunities. Implementation. Define strict entry rules for your trades. Only execute trades that fully meet these criteria. Track skip trades to see how avoiding low-quality setups impacts overall performance and profitability. Meaning, focusing on quality over quantity reduces emotional strain, minimizes unnecessary risk, and increases the chances of consistent profits. It reinforces disciplined, strategic trading rather than I habit it. Master technical and fundamental analysis. Successful traders use both technical and fundamental analysis to make informed decisions. Technical analysis involves studying price movements, trends, support and resistance levels, and chart patterns. Fundamental analysis focuses on economic data, company financials, and broader market indicators. By combining these approaches, traders gain a clearer understanding of market behavior and potential opportunities. Example: Warren Buffett primarily uses fundamental analysis to determine the intrinsic value of companies before investing. On the other hand, Ed Seykota, a legendary trader, relies heavily on technical analysis to identify price trends and trading opportunities. Traders who integrate both methods can make more informed and balanced decisions. Implementation. Spend dedicated time learning technical indicators, chart patterns, and key economic indicators. Backtest strategies that combine technical and fundamental insights to determine which approaches yield consistent results. Practice applying both types of analysis to real market scenarios to build confidence. Meaning, mastering both technical and fundamental analysis allows traders to see the market from multiple perspectives, make informed decisions, and reduce uncertainty. It helps balance short-term price movements with long-term market fundamentals, increasing the chances of consistent profitability and strategic success. Habit 9. Adopt a growth mindset. Successful traders embrace a growth mindset, seeing mistakes and losses as opportunities to learn rather than failures. They are constantly seeking ways to improve their skills, strategies, and decision-making. Viewing losses as feedback allows traders to refine their approach, become more resilient, and increase their chances of long-term success. Example: Bruce Kovner, a legendary trader, treats every loss as a lesson. He carefully analyzes mistakes to understand what went wrong, ensuring each experience leads to better decisions in the future. This mindset helps him adapt and improve continuously. Implementation. After every losing trade, take time to reflect and ask yourself, what went wrong in this trade? How can I avoid making the same mistake in the future? Did I follow my trading plan correctly? Keep a journal of your reflections and review it regularly. Use these insights to make small, continuous improvements in your trading strategy. Meaning, adopting a growth mindset helps traders learn from experiences, overcome setbacks, and develop resilience. It encourages continuous improvement, reduces emotional reactions to losses, and fosters a strategic approach to trading that focuses on long-term growth rather than short-term results. Habit 10. Leverage technology for trading. Successful traders use technology to improve efficiency, make faster decisions, and reduce errors. Trading platforms, charting software, data analysis tools, automated alerts, and algorithmic systems help traders identify opportunities, manage risk, and execute trades effectively. Example: Jim Simons, founder of Renaissance Technologies, uses advanced quantitative algorithms to analyze huge datasets and find profitable trading patterns. While most retail traders don't operate at this scale, using tools like TradingView, automated alerts, and backtesting software still provide a strong advantage in identifying high-probability trades. Implementation. Explore trading platforms and tools that match your trading style. Automate repetitive tasks such as alerts, stop-loss placement, or position sizing to minimize emotional decision-making. Use backtesting software to evaluate strategies before applying them in live markets. Meaning, leveraging technology allows traders to make data-driven decisions, save time, reduce errors, and stay competitive. It enhances precision, consistency, and efficiency, giving both professional and retail traders an edge in fast-moving markets. Habit 11. Develop a consistent trading routine. Successful traders rely on consistency, and establishing a daily trading routine is key to achieving discipline and focus. A well-structured routine includes pre-market preparation, market analysis, trade planning, executing trades, and post-market review. Following a routine helps reduce impulsive decisions, keeps the mind sharp, and ensures you're emotionally prepared for the trading day. Example: Paul Tudor Jones follows a strict daily schedule. He starts by reading economic reports, analyzing charts, and reviewing positions before placing any trades. This structured approach allows him to remain calm and focused even during volatile market conditions, making strategic rather than emotional decisions. Implementation. Create and follow a daily routine. Wake up at a consistent time every day. Review overnight market news, global events, and economic indicators. Analyze charts and identify potential high-probability setups. Write down a clear trade plan for the day. Execute trades according to your plan, avoiding impulsive actions. After market close, review performance, journal outcomes, and reflect on lessons learned. Meaning, over time, a consistent trading routine becomes automatic, helping you maintain discipline, reduce stress, and improve efficiency. It strengthens mental and emotional control, enhances focus, and supports consistent performance in the markets, turning trading into a structured, professional practice rather than a reactive activity. Habit 12. Control greed and fear. The markets are full of emotional highs and lows, and the two most dangerous emotions for traders are greed and fear. Greed can lead to holding losing positions too long or chasing trades that don't meet your plan, while fear can prevent you from taking profitable opportunities. Successful traders recognize these emotions and train themselves to respond to facts rather than feelings, allowing rational and disciplined decision-making even under pressure. Example: Jesse Livermore, a legendary trader, experienced huge losses and gains throughout his career. He noted that many losses occurred when greed led him to break his own rules, such as holding on to losing positions in hopes they would recover. On the other hand, fear sometimes caused him to miss profitable trades that met his criteria. Implementation. To control greed and fear, follow these steps. Before each trade, ask yourself, am I following my trading plan or acting on emotion? Establish strict profit-taking and stop-loss rules to minimize emotional influence. Practice mindfulness, meditation, or other techniques to strengthen emotional control. Review past trades to identify instances where greed or fear affected decisions and develop strategies to prevent recurrence. Meaning, mastering greed and fear gives traders a competitive edge by ensuring decisions are made based on analysis and probability, not emotion. This discipline helps maintain consistency, protects capital, and increases the likelihood of long-term trading success. Habit 13. Prioritize risk-to-reward ratio. Successful traders focus on trades that offer a favorable risk-to-reward ratio, often aiming for 1 to 2 or higher. This approach ensures that even if some trades are unsuccessful, the profits from winning trades compensate for losses and result in overall gains. By prioritizing risk to reward, traders avoid reckless decisions and maintain long-term profitability. Example: Mark Minervini, a U.S. investing champion, carefully seeks setups where potential gains are significantly higher than potential losses. By adhering to strict risk-to-reward ratios, traders can remain profitable even with a relatively low win rate, as the larger winners outweigh the smaller losses. Implementation. To implement this habit effectively, calculate the potential profit and potential loss for each trade before entering. Avoid trades where the potential loss is greater than the potential gain, or where a clear stop loss cannot be defined. Adjust your position size to align with your maximum acceptable risk per trade. Maintain discipline and do not deviate from risk-to-reward criteria, even if the trade feels sure. Meaning, focusing on risk-to-reward fosters disciplined trading, reduces the impact of losing trades, and encourages strategic decision-making. It helps traders maintain a long-term edge in the markets rather than chasing every opportunity impulsively. Habit 14. Use stop-loss orders. Strategically, stop-loss orders are essential tools for protecting capital and preventing emotional decision-making. Successful traders treat stop-losses as non-negotiable and only adjust them when the market moves favorably. By using stops effectively, traders can limit losses, manage risk, and preserve funds for future opportunities. Example: Stanley Druckenmiller stresses the importance of using stop-loss orders to protect capital. By cutting losses early, he ensures that he has the funds available to capitalize on the next profitable opportunity, rather than risking large drawdowns. Implementation. To use stop-loss orders effectively, determine your stop-loss based on market volatility, trade setup, and personal risk tolerance. Never move your stop-loss further away hoping the trade will recover. Accept losses as a natural part of trading. Adjust stop-loss only when the trade is clearly trending in your favor to lock in profits, thereby protecting gains. Treat stop-losses as mandatory. Breaking this rule can lead to unnecessary losses and emotional stress. Meaning, strategic use of stop-loss orders is fundamental to long-term survival in the markets. Preserving capital is far more important than winning every trade. By controlling losses and staying disciplined, traders increase their chances of long-term success and consistency in the markets. Habit 15. Practice proper position sizing. Successful traders never risk too much capital on a single trade. Position sizing involves calculating how many units or shares to trade, so that even if a trade goes against you, it does not significantly impact your overall account. This disciplined approach protects capital and allows for steady, long-term growth. Example: Etsy Koda, a legendary trend-following trader, emphasizes that success depends largely on proper position sizing. Even if he experiences a few losing trades in a row, his account continues to grow because no single loss is large enough to be catastrophic. Implementation. To practice proper position sizing, use a fixed percentage of your total capital for each trade, commonly 1%, 2%. Adjust the size of your positions based on market volatility. Use smaller positions in more volatile conditions. Combine position size with stop-loss levels to maintain consistent risk exposure across trades. Recalculate position sizes as your account grows or shrinks to ensure ongoing risk management. Meaning, proper position sizing prevents emotional stress, reduces the impact of losses, and ensures steady, sustainable growth. It is a hallmark of top traders and a fundamental practice for long-term trading success. Habit 16. Observe market psychology. Successful traders understand that markets are heavily influenced by human emotions such as fear, greed, optimism, and panic. Recognizing these behavioral patterns allows traders to anticipate potential market moves and make decisions that capitalize on crowd behavior rather than simply following it. Example: Warren Buffett often invests when others are fearful and sells when the market is euphoric, taking advantage of herd mentality. Short-term traders also use sentiment indicators like the VIX, trading volume spikes, or social media sentiment to predict potential reversals and market shifts. Implementation. To observe market psychology effectively, monitor news headlines, social media sentiment, and general market chatter. Identify extreme emotional reactions such as panic selling or euphoric buying, which can signal potential trading opportunities. Combine sentiment analysis with technical and fundamental data to form a well-rounded view of the market. Maintain a journal of observed patterns to refine your understanding over time. Meaning, understanding market psychology enables traders to act contrarily when necessary, rather than following the crowd blindly. This habit provides a competitive advantage, helping traders make strategic, high-probability decisions that separate consistent winners from average traders. Habit 17. Practice backtesting and simulation before risking real money. Successful traders test their strategies on historical data to ensure they are profitable under different market conditions. This practice allows them to refine strategies, identify potential weaknesses, and gain confidence in their approach. Example: Jim Simons, founder of Renaissance Technologies, developed his quantitative strategies entirely through rigorous backtesting, analyzing massive datasets to find reliable patterns before executing trades. Retail traders can replicate this on a smaller scale, using platforms like TradingView or NinjaTrader to test strategies without financial risk. Implementation. To backtest effectively, choose a trading strategy and test it on at least 3 to 5 years of historical data. Record key metrics including win rates, risk-reward ratios, drawdowns, and overall profitability. Adjust and refine the strategy based on the backtesting results to improve consistency. Continuously retest after modifications to ensure reliability before implementing in live markets. Meaning, backtesting and simulation instill confidence and remove guesswork, transforming trading from gambling into a systematic, data-driven process. It allows traders to understand how their strategies perform across various market conditions, improving decision-making and low habit 18. Set realistic goals. Top traders establish specific, measurable, and achievable goals for their trading. These goals focus on consistent, incremental gains and maintaining proper risk management, rather than trying to win every trade or make a large profit immediately. Example: Bruce Kovner, a legendary trader, emphasized small, consistent profits over time. His objective was not to hit a home run with every trade, but to steadily compound his capital, demonstrating the power of patience and realistic expectations. Implementation. To set realistic trading goals, define monthly, quarterly, and yearly profit targets that are achievable and aligned with your risk tolerance. Establish risk and maximum loss limits to ensure your goals remain realistic. Regularly review your progress and adjust goals based on performance, changing market conditions, and improvements in skill. Meaning, clear, realistic goals provide motivation, direction, and focus. They prevent reckless trading driven by impatience or greed and help traders develop a disciplined, long-term approach to growing capital steadily and sustainably. Habit 19. Network and learn from mentors. Successful traders actively connect with experienced traders to learn from their strategies, mistakes, and insights. Mentorship and networking accelerate growth, provide guidance, and reduce the trial and error period that can be costly for beginners. Example: Irving Kahn learned investing from Benjamin Graham, applying his mentor's principles for decades. Mentorship gave him real-world trading wisdom that went beyond what books alone could teach, helping him make informed decisions throughout his career. Implementation. To benefit from networking and mentorship, join trading communities, online forums, or local investor clubs to share ideas and experiences. Attend webinars, workshops, or seminars led by experienced traders to gain knowledge. Seek a mentor who can review your trades, provide feedback, and share insights based on experience. Regularly engage with peers and mentors to discuss strategies, market trends, and lessons learned. Meaning, networking and learning from mentors exposes traders to diverse perspectives, accelerates learning, and provides practical guidance. This habit helps shorten the learning curve, improves decision-making, and increases the likelihood of long-term trading success. Habit 20. Review and reflect daily. Top traders dedicate time at the end of each trading day to review their trades and market movements. This habit helps improve strategies, identify mistakes, reinforce discipline, and promote continuous learning. Example: Paul Tudor Jones examines charts and evaluates his daily performance to adjust strategies. By reflecting on successes and errors, He adapts to changing market conditions and refines his techniques over time. Implementation. To implement daily reflection. At the end of each trading day, review all executed trades in detail. Ask yourself, which trades followed my plan, which didn't? Wide document lessons learned, noting both mistakes and successful decisions, and update your trading journal accordingly. Use insights from reflection to adjust future strategies and decision-making processes. Meaning, daily review and reflection ensure continuous improvement, prevent repeating mistakes, and reinforce disciplined trading. It allows traders to learn from experience, enhance skills, and make better-informed decisions in the future. Habit 21. Develop a strong analytical mindset. Successful traders cultivate a sharp, analytical mindset, allowing them to dissect charts, interpret data, and predict market behavior. They rely on systematic analysis rather than luck or guesswork, examining trends, patterns, trading volume, and economic indicators to make calculated, informed decisions. Example, Ed Seykota, a pioneer of computerized trading, credits much of his success to meticulous analysis. He studies price patterns and trends systematically, spotting opportunities that others often miss. Similarly, Warren Buffett carefully dissects financial statements and evaluates market conditions with precision before making investments. Implementation. To develop a strong analytical mindset. 1. Dedicate time to learning both technical and fundamental analysis. Break down charts by time frame, trend, and volume to understand market behavior. Study economic reports, news, and their impact on specific assets. Ask analytical questions for each trade. Why is this asset moving? Is this movement sustainable? 5. Combine insights from multiple sources to form reasoned trading decisions. Meaning, a strong analytical mindset transforms trading from guessing into making reasoned predictions. It enables traders to act with confidence, evaluate opportunities thoroughly, and consistently make informed, strategic decisions that enhance profitability. Habit 22. Embrace a long-term perspective. While many traders concentrate on short-term gains, the most successful understand the power of long-term compounding and patience. They balance short-term trades with longer-term investments, recognizing that time amplifies returns and smooths out market volatility. Example, Benjamin Graham and his students, including Irving Kahn, consistently invested in undervalued companies and held positions for many years. Warren Buffett famously stated, "Our favorite holding period is forever," emphasizing the advantage of long-term thinking in building wealth. Implementation. To adopt a long-term perspective, allocate a portion of your capital to long-term investments or trend trades that can grow over months or years. Avoid overreacting to short-term market fluctuations or temporary losses. Focus on cumulative performance and overall portfolio growth rather than daily gains or losses. Reassess long-term positions periodically, but avoid frequent, emotion-driven trading. Meaning, embracing a long-term perspective allows traders to weather market volatility, reduces stress caused by short-term swings, and maximizes the benefits of compounding. It cultivates patience and strategic thinking, providing a stable foundation for sustainable trading success. Habit 23. Master trend identification. Recognizing market trends early is critical for maximizing profits. Successful traders distinguish between short-term market noise and genuine trends, positioning themselves to ride these trends rather than fight them. Trend identification allows traders to enter positions with higher probability setups and capture sustained moves. Example, Paul Tudor Jones uses technical indicators like moving averages and price momentum to identify trends. He waits for confirmation signals before entering trades, which helps him avoid false breakouts and capitalize on longer-term moves. Implementation. To master trend identification. 1. Study multiple time frames to confirm the overall market trend. Use trend indicators such as moving averages, MACD, and ADX to identify direction and strength. Look for higher highs and higher lows in uptrends and lower highs and lower lows in downtrends. Enter trades in the direction of the trend and plan exits when signs of a reversal or trend weakening appear. Continuously monitor trend strength and adjust positions accordingly. Meaning, mastering trend identification allows traders to align with the market rather than fight it, significantly improving win rates and profitability. Understanding trends ensures that trading decisions are based on market dynamics rather than guesswork or emotion. Habit 24. Practice adaptability. Markets are constantly evolving, and rigid trading strategies often fail in dynamic conditions. Successful traders are adaptable. They adjust their strategies based on changes in volatility, liquidity, and macroeconomic factors. Adaptability allows traders to respond effectively to unexpected events and maintain consistent performance. Example: Stanley Druckenmiller frequently adjusts his trades in response to changing interest rates, geopolitical events, or market sentiment. He emphasizes that flexibility often produces better results than stubbornly sticking to a single method, as the market environment is always shifting. Implementation. To cultivate adaptability, monitor macroeconomic events, global trends, and news that may impact markets. Evaluate the effectiveness of your trading strategies in the current market conditions. Be prepared to pivot, modify, or pause trading if market conditions become unfavorable. Keep a flexible mindset, reviewing and adjusting your trading plan as needed. Meaning, practicing adaptability ensures survival in markets that are inherently unpredictable and fluid. It allows traders to adjust their approach, capitalize on emerging opportunities, and avoid losses caused by rigid strategies. Habit 25. Avoid overtrading is a major threat to trading accounts, often leading to unnecessary losses and emotional stress. Successful traders understand that trading less frequently, but with high-quality setups, is far more profitable than constant activity. They wait for high-probability opportunities rather than forcing trades. Example: Richard Dennis, the founder of the Turtle Traders, taught his students to only trade when setups met strict criteria. Beginners who overtraded, entering low-probability trades out of boredom or impatience, often suffered losses. By focusing on selective, high-quality trades, his students could achieve consistent profitability. Implementation. To avoid overtrading: 1. Define clear entry criteria for every trade to ensure it meets your strategy requirements. Track the number of trades per day or week and analyze success rates to identify overtrading patterns. Resist the urge to trade simply because the market is moving or due to emotional impulses. Focus on patience, waiting for setups that align with your strategy. Meaning, by prioritizing quality over quantity, traders reduce emotional stress, improve decision-making, and maintain a stronger edge in the market. Avoiding overtrading supports long-term profitability and disciplined trading behavior. Habit 26. Study market history. Financial markets often exhibit recurring patterns, and understanding historical events can provide valuable insight for traders. Successful traders study past market cycles, crashes, and rallies to anticipate potential future movements and avoid repeating mistakes. Example: Warren Buffett frequently studies past market bubbles, such as the dot-com bubble, to steer clear of overvalued sectors. Paul Tudor Jones draws lessons from the 1929 stock market crash to identify parallels in contemporary markets and adjust his strategies accordingly. Implementation. To effectively study market history, review major historical market events, understanding the causes, consequences, and investor behavior. Analyze charts of previous bull and bear markets to identify recurring trends and patterns. Learn from the mistakes and successes of other traders during past market conditions. Incorporate historical insights into your trading plan to anticipate potential scenarios. Meaning, studying market history provides essential context, allowing traders to make informed decisions and reduce the likelihood of repeating errors. By understanding historical patterns, traders can recognize early signs of similar situations, enhancing their strategic foresight and decision-making. Habit 27. Use multiple time frame analysis. Top traders analyze charts across multiple time frames to gain a broader perspective. A trend visible on a short-term chart may be insignificant noise when viewed on a longer time frame. Cross-timeframe analysis helps confirm trades and reduces the likelihood of entering low-probability setups. Example: a trader may observe a short-term uptrend on an hourly chart, but see that the daily chart is in a major downtrend. In such a scenario, they might avoid taking a long trade, thereby protecting their capital from potential losses caused by the dominant trend. Implementation: to practice multiple time frame analysis. 1. Analyze charts from long-term daily, weekly to short-term hourly, minute to identify overall market context. Look for alignment of trends across time frames to confirm the validity of a trade. Use higher time frame trends to guide your position direction and risk management decisions in lower time frames. Combine insights from multiple time frames with other technical and fundamental indicators for a comprehensive view. Meaning, using multiple time frame analysis improves trade accuracy and reduces false signals. It allows traders to align with dominant trends, avoid low-probability trades, and make better informed decisions, which is essential for consistent profitability. Habit 28. Learn from losses. Every trader experiences losses, but successful traders differentiate themselves by learning from these setbacks rather than ignoring them. By analyzing mistakes, identifying patterns, and applying lessons to future trades, they continuously evolve and improve their strategies. Example: Bruce Kovner attributes much of his success to carefully studying his losing trades. By understanding why a trade failed, he adjusts his strategies and ensures he does not repeat the same errors, turning losses into valuable learning experiences. Implementation: to effectively learn from losses, keep a separate section in your trading journal dedicated to losses and analyze each one in detail. Ask yourself, what could have been avoided? Did I follow my risk management rules? Apply the insights gained to refine your trading strategy. Mentally acknowledge the loss and move on to the next trade without carrying emotional baggage. Meaning, embracing losses as learning opportunities cultivates a resilient and evolving trader mindset. This habit enhances decision-making, builds discipline, and ensures continuous improvement, turning setbacks into tools for long-term success. Habit 29. Maintain physical and mental health. Successful traders understand that trading is mentally and physically demanding. Fatigue, stress, or poor health can impair judgment, slow reaction times, and lead to impulsive decisions. Maintaining optimal physical and mental health is essential for consistent performance. Example: Paul Tudor Jones emphasizes daily exercise, adequate sleep, and mental relaxation to maintain focus. By keeping both body and mind in peak condition, he enhances discipline, clarity, and the ability to respond effectively in high-pressure market situations. Implementation: to maintain health for trading, follow a regular exercise routine and maintain a balanced, nutritious diet. Take breaks from screens and markets to prevent mental fatigue and burnout. Practice stress-reducing activities such as meditation, yoga, or deep breathing exercises. Prioritize sleep and mental recovery to ensure optimal cognitive function. Meaning, a trader in optimal physical and mental health can think clearly, execute trading plans effectively, and resist impulsive or emotional decisions. Prioritizing well-being supports discipline, focus, and long-term trading success. Habit 30. Stay humble and avoid ego. Ego is a major barrier to consistent trading. Even the most successful traders make mistakes, and humility enables them to accept losses, take advice, and continually improve their strategies. Avoiding ego-driven decisions prevents unnecessary risks and supports long-term growth. Example: Warren Buffett remains humble despite his immense wealth, often crediting mentors and staying cautious about overconfidence. Traders who fail to admit mistakes or act out of pride can compound losses and make poor decisions due to stubbornness. Implementation: to stay humble in trading, reflect on each trade objectively, regardless of the outcome. Accept constructive feedback and advice from mentors, peers, or trading communities. Avoid making trades driven by pride, ego, or the desire to prove something. Regularly self-assess and acknowledge areas for improvement. Meaning, humility allows traders to learn, adapt, and grow continuously. By keeping ego in check, traders make better decisions, avoid unnecessary risks, and build a foundation for long-term trading success. Habit 31. Practice patience with trade execution. Patience in trading extends beyond waiting for setups. It also involves executing trades at the right moment. Successful traders understand that entering too early or too late can turn a potentially profitable trade into a loss. Timing is critical for maximizing profits and minimizing risk. Example: Paul Tudor Jones waits for clear breakout confirmations rather than reacting to the first sign of price movement. Similarly, Warren Buffett waits until he identifies significant undervaluation before investing in a company. Premature entries can result in unnecessary drawdowns and missed opportunities. Implementation. To practice patience with trade execution. 1. Identify precise entry conditions before placing any trade. Wait for confirmation signals, such as completion of a candle pattern, trendline break, or alignment of technical indicators. Use limit orders to enter trades at specific levels rather than market orders, ensuring accuracy. Document instances where impatience led to losses in your trading journal to reinforce lessons learned. Meaning, exercising precision patience enhances the probability of trade success, reduces unnecessary risk exposure, and allows traders to enter positions at optimal levels. This habit supports disciplined, strategic trading and long-term profitability. Habit 32. Diversify across assets and strategies. Top traders avoid concentrating all their capital in a single asset or strategy. Strategic diversification reduces risk and provides more consistent returns. This approach is not about spreading capital indiscriminately, but about carefully allocating resources across markets, instruments, and trading strategies to balance risk and reward. Example: Ray Dalio's all-weather portfolio exemplifies strategic diversification. By balancing exposure across stocks, bonds, commodities, and currencies, he hedges against various economic scenarios, ensuring stability and consistent returns regardless of market conditions. Implementation. To diversify effectively, allocate capital to multiple instruments such as stocks, forex, commodities, and ETFs. Employ different trading strategies, including trend following, mean reversion, and breakout trades. Monitor correlations between assets, ensuring low correlation to minimize the risk of simultaneous losses. Adjust allocations periodically based on market conditions and portfolio performance. Meaning, diversification enables traders to survive market turbulence, reduce portfolio risk, and compound gains from multiple sources. It supports long-term stability and enhances the probability of consistent profitability. Habit 33. Maintain high focus during trading. Concentration is essential in trading, as distractions can lead to mistakes that erode profits. Successful traders maintain high focus during critical trading hours, filtering out irrelevant information and noise to make precise, informed decisions. Example: Jesse Livermore stressed the importance of mental clarity in trading. He would eliminate distractions, focus entirely on charts and price action, and make decisions calmly, demonstrating that mental discipline is key to success. Implementation. To maintain high focus during trading, create a dedicated, quiet trading environment free from distractions. Limit news and social media consumption to essential market updates only. Avoid multitasking during market hours to preserve concentration. Utilize techniques such as the Pomodoro method to maintain sustained attention and mental clarity. Take short breaks to prevent fatigue and maintain peak cognitive performance. Meaning, high focus allows traders to detect subtle signals, avoid impulsive actions, and execute trades with precision. Maintaining concentration is a cornerstone habit for consistent profitability and disciplined trading. Habit 34. Understand market liquidity. Liquidity is a key factor in trading, determining how easily positions can be entered or exited. Successful traders recognize that low liquidity markets carry higher slippage, increased volatility, and additional risk, and they adjust strategies accordingly to protect capital. Example: Paul Tudor Jones avoids thinly traded markets unless the spreads and risk are acceptable. Misjudging liquidity can lead to unexpected losses, particularly when attempting to exit a trade, as low liquidity can cause significant slippage. Implementation: to account for market liquidity, check average trading volume and bid-ask spreads before entering any trade. Avoid over-leveraging in illiquid markets to reduce potential losses. Adjust position sizes based on liquidity to minimize slippage risk. Prefer highly liquid instruments for large trades or quick entries and exits. Meaning, understanding market liquidity ensures trades can be executed at intended prices, reducing risk and emotional stress. Traders who account for liquidity can make more precise, efficient decisions and safeguard their capital. Habit 35. Follow market trends, not opinions. Markets operate independently of personal opinions or news hype. Successful traders base decisions on objective data, technical analysis, and observable trends, rather than succumbing to speculation, emotions, or popular sentiment. Example: Stanley Druckenmiller avoided trading based solely on economic forecasts or pundit predictions. Instead, he let actual price movements and trend confirmations guide his decisions, adjusting positions as market dynamics evolved. Implementation: to follow trends rather than opinions. Base trades on technical confirmation, statistical probabilities, and trend analysis. Avoid reacting impulsively to sensational news unless it aligns with your trading setup. Regularly review trade outcomes to ensure decisions were data-driven rather than emotion-driven. Document instances where opinions influenced past trades and identify lessons learned. Meaning, following market trends instead of opinions allows traders to align with market reality, reduce bias, and enhance consistency. This habit ensures decisions are grounded in observable market behavior, improving the probability of success. Habit 36. Avoid revenge trading after experiencing a loss. Many traders impulsively attempt to win it back, often compounding mistakes and increasing risk. Successful traders accept losses as part of trading, take a pause, and return with a calm, methodical approach. Example: Bruce Kovner emphasizes that emotional trading following losses is a recipe for disaster. Even a single revenge trade can erase weeks of careful planning and strategy execution. Implementation: to avoid revenge trading, take a cooling-off period after any losing trade to regain emotional balance. Objectively review the loss and document lessons learned in your trading journal. Resume trading only when your mindset is calm, focused, and aligned with your strategy. Set rules to prevent immediate reentry after significant losses. Meaning, avoiding revenge trading ensures psychological stability, prevents the emotional compounding of losses, and maintains discipline. This habit protects capital and supports consistent, rational trading performance. Habit 37. Use checklists for trade setup. Top traders utilize checklists to verify that all conditions for a trade are met. This systematic approach minimizes human error, enforces discipline, and ensures that trades are executed according to the predefined plan rather than impulse. Example: professional traders often maintain pre-trade checklists that confirm trend direction, volatility levels, risk-reward ratios, liquidity, and relevant macroeconomic factors before executing trades. Implementation: to implement trade checklists. 1. Create a comprehensive checklist covering all entry, exit, and risk management conditions. Verify each item on the checklist before placing a trade. Document adherence to the checklist in your trading journal for post-trade review and accountability. Periodically update the checklist based on lessons learned and evolving market conditions. Meaning, using checklists transforms trading into a discipline-driven process, reducing errors caused by oversight or emotional bias. This habit ensures consistency, improves decision-making, and enhances long-term profitability. Habit 38. Recognize market patterns. Successful traders identify recurring market patterns, including both simple candlestick formations and more complex chart structures. Recognizing these patterns allows traders to anticipate market movements and plan precise entries and exits. Example: Ed Seykota and Jesse Livermore achieved consistent profits by identifying breakout and reversal patterns. Livermore, in particular, utilized pivot points to forecast market turning points and position himself advantageously. Implementation: to recognize market patterns effectively, study classical chart patterns such as head and shoulders, double tops, slash bottoms, and triangles. Learn candlestick formations including doji candlestick, engulfing, hammer, and shooting star patterns. Backtest identified patterns on historical data to ensure their reliability before applying them in live trading. Integrate pattern recognition with other technical indicators to confirm trade signals. Meaning, pattern recognition converts raw market data into actionable insights, allowing traders to anticipate price movements and make informed, high-probability trading decisions. Mastery of this skill enhances precision and consistency in trading. Habit 39. Manage leverage wisely. Leverage can amplify profits, but it also magnifies losses. Successful traders use leverage cautiously, understanding the risks involved and ensuring that their account is never overexposed. Proper leverage management is crucial for preserving capital and maintaining long-term survivability. Example: many traders fail because they over-leverage in pursuit of high returns. In contrast, Paul Tudor Jones employs leverage strategically, combining it with strict risk management rules to enhance returns while protecting his capital from catastrophic losses. Implementation: to manage leverage effectively, determine the maximum allowable leverage based on your risk tolerance and trading strategy. Adjust leverage levels according to market volatility, using lower leverage in uncertain or highly volatile conditions. Treat leverage as a tool for calculated advantage, not a shortcut to quick profits. Monitor positions closely and ensure margin requirements are maintained to avoid forced liquidation. Meaning, wise leverage management safeguards capital, reduces stress, and ensures long-term survivability in volatile markets. It allows traders to benefit from leveraged opportunities without compromising their overall trading account. Habit 40. Practice continuous self-discipline. Discipline is the foundation of all successful trading habits. Even the most effective strategies can fail without consistent self-control and adherence to rules. Traders must enforce their own boundaries and resist temptations that could undermine their system. Example: Warren Buffett rigorously follows his investment principles, avoiding market hype or speculative trends. Jesse Livermore highlighted that discipline distinguishes consistent winners from gamblers, as it ensures that trading decisions are methodical rather than impulsive. Implementation: to cultivate continuous self-discipline, follow your trading plan meticulously, making no exceptions. Establish daily, weekly, and monthly rules for trading activity, including position sizing, risk limits, and trade frequency. Use a trading journal to monitor adherence, document lapses in discipline, and reflect on ways to reinforce consistent behavior. Reward disciplined behavior and review deviations to prevent recurring mistakes. Meaning, continuous self-discipline ensures that a trader's knowledge, skills, and strategies are effectively applied. It minimizes emotional interference, reinforces consistency, and supports long-term trading success. Habit 41. Practice continuous market observation. Successful traders maintain constant awareness of market movements, even when not actively trading. They study price action, volume, volatility, and news events, developing a deep understanding and intuition for the market's rhythm. Example: Paul Tudor Jones dedicates hours to observing charts and market behavior without entering trades, identifying subtle shifts in momentum, sentiment, and patterns. This practice allows him to anticipate market moves and position himself advantageously when the right opportunity arises. Implementation: to practice continuous market observation. 1. Dedicate daily time to watch the markets without executing trades. Note patterns, anomalies, and recurring behaviors across different time frames. Document observations to refine trading setups, improve timing, and enhance decision-making. Use observation insights to complement analytical tools and strategy development. Meaning, continuous market observation helps traders internalize market behavior, building intuition that strengthens analytical skills. This habit improves timing, trade accuracy, and overall market awareness, contributing to consistent trading success. Habit 42. Focus on high-probability trades. Top traders only engage in trades that offer a statistically favorable outcome. They avoid low-probability setups, which amount to guesses, and concentrate on opportunities where their edge is strongest, maximizing efficiency and profitability. Example, Ed Seykota emphasizes that his trading system identifies setups with historically high success rates. Even with a moderate win rate, proper risk-reward management ensures consistent profitability over time. Implementation. To focus on high-probability trades, establish clear, objective criteria for trade selection based on historical data and proven setups. Evaluate the success rate of each trade setup before execution. Avoid emotional or impulsive trades that do not meet your defined criteria. Continuously review and refine criteria based on market conditions and trading performance. Meaning, focusing on high-probability trades allows traders to leverage their edge consistently, enhancing profitability while reducing unnecessary risk. This habit ensures disciplined, data-driven trading rather than speculation. Habit 45. Practice mental resilience. Trading can be emotionally demanding, particularly during periods of high volatility or prolonged losing streaks. Successful traders cultivate mental resilience to maintain discipline, manage stress, and make rational decisions under pressure. Example, Jesse Livermore experienced dramatic swings in fortune, yet remained mentally resilient, using each experience to refine his trading strategy. Contemporary traders employ similar techniques to stay calm and focused in stressful market conditions. Implementation. To practice mental resilience, develop daily routines for stress management, such as meditation, deep breathing exercises, or mindfulness practices. Visualize challenging market scenarios and mentally rehearse disciplined responses. Treat losses as learning opportunities rather than personal failures. Take breaks as needed to reset focus and prevent emotional fatigue. Meaning, mental resilience enables traders to navigate market chaos without compromising their strategy or judgment. This habit supports consistent decision-making, emotional stability, and long-term trading success. Habit 46. Leverage journals for strategic growth. A trading journal is not merely a record of trades. It is a powerful tool for continuous strategic improvement. Successful traders meticulously document setups, reasoning, emotions, mistakes, and outcomes to extract lessons and refine their approach over time. Example, Jason Zweig highlights that journaling allows traders to identify emotional triggers and recurring errors, providing a foundation for constant strategy refinement and disciplined decision-making. Implementation. To leverage journals for strategic growth. 1. Record every trade with detailed reasoning, market context, and emotional state. Review your journal weekly to identify patterns of mistakes, missed opportunities, and areas for improvement. Update and adjust strategies based on insights gained from the journal. Reflect periodically on long-term trends in your trading performance to enhance skill development. Meaning, maintaining a robust journaling habit transforms trading experience into systematic knowledge, accelerates mastery, and reinforces disciplined, informed decision-making. Habit 43. Develop patience during drawdowns. Even the most successful trading strategies experience periods of losses or drawdowns. Top traders remain calm, trust their systems, and avoid abandoning their strategies prematurely. They understand that drawdowns are a natural part of the trading journey and an opportunity to reinforce discipline. Example, Bruce Kovner faced multiple drawdowns early in his career but adhered to his risk management rules and strategy, eventually achieving significant profitability. Similarly, Warren Buffett's investments occasionally decline temporarily, Yet his long-term perspective and patience allow him to capitalize on the eventual recovery. Implementation. To develop patience during drawdowns. 1. Understand your trading system's historical and expected drawdowns. Maintain strict risk parameters to survive losing streaks without emotional panic. Reflect objectively on drawdowns, documenting lessons learned, and adjusting only if recurring patterns indicate improvements are necessary. Focus on long-term performance rather than short-term fluctuations. Meaning, patience during drawdowns allows traders to remain disciplined, trust their systems, and capitalize on their long-term edge. This habit prevents emotional decision-making and reinforces sustainable trading success. Habit 44. Incorporate quantitative analysis. Successful traders increasingly utilize quantitative methods, including algorithms, statistical models, and backtested strategies, to enhance decision-making. Quantitative analysis reduces human bias and emotional errors, allowing for data-driven, consistent trading. Example: Jim Simons, founder of Renaissance Technologies, built his trading empire through quantitative analysis. He systematically exploited statistical patterns in vast data sets, identifying opportunities invisible to human intuition. Implementation. To incorporate quantitative analysis. Collect relevant data on price movements, volatility, and market correlations. Apply statistical models to test trading hypotheses and identify reliable patterns. Backtest quantitative strategies over historical data to assess performance and risk. Gradually integrate quantitative rules into your existing trading strategy to improve consistency and reduce emotional bias. Continuously monitor and refine models to adapt to evolving market conditions. Meaning, quantitative analysis transforms trading from intuition-based to data-driven and repeatable. This habit enhances reliability, reduces errors caused by emotion, and allows traders to make more objective, systematic decisions. Habit 47. Master entry and exit timing. Knowing the optimal moments to enter and exit trades is as critical as the strategy itself. Successful traders time their entries at favorable levels and exits to maximize gains or minimize losses, integrating both technical analysis and risk management. Example: Paul Tudor Jones employs precise entry techniques, including breakout confirmations and trend alignment. He dynamically adjusts exit strategies using trailing stops and defined profit targets to capture maximum value while protecting capital. Implementation. To master entry and exit timing. Define explicit entry and exit criteria for every trade. Utilize technical indicators, chart patterns, and key support and resistance levels to guide timing decisions. Adjust exits dynamically based on risk management principles and trend continuation. Backtest timing strategies to confirm effectiveness before live execution. Meaning, mastering entry and exit timing increases profit potential, enhances risk control, and is fundamental for high-performance, consistent trading. Habit 48. Continuously adapt to market conditions. Markets are constantly evolving due to technological advancements, globalization, and macroeconomic changes. Successful traders continually adapt their strategies to remain relevant, competitive, and profitable. Example: Warren Buffett shifted from strict cigar but investing to focusing on high-quality businesses as market dynamics evolved. Paul Tudor Jones adjusted his approach in response to new financial instruments and global events, ensuring consistent performance. Implementation. To continuously adapt to market conditions, regularly evaluate the performance and effectiveness of your trading strategies. Monitor technological, economic, and regulatory changes that may impact your markets. Stay flexible and be willing to modify rules, indicators, or asset focus as conditions evolve. Incorporate feedback from past trades to refine approaches. Meaning, continuous adaptation ensures longevity in trading, protects against obsolescence, and allows traders to thrive in changing market environments by remaining flexible and informed. Habit 49. Practice mindful decision-making. Mindful trading requires awareness of your emotions, focus on the present, and making conscious, deliberate choices. Impulsive or mindless trading often leads to mistakes, while mindfulness fosters clarity, rationality, and discipline. Example: Jesse Livermore emphasized calm, deliberate analysis before executing trades. Contemporary traders use mindfulness techniques to remain objective, preventing fear or greed from influencing decisions. Implementation: to practice mindful decision-making, pause before each trade to assess your emotional state. Focus on current market conditions rather than dwelling on past mistakes or projecting future outcomes. Incorporate mindfulness exercises or meditation into your daily routine to maintain present-focused awareness. Review trades with a mindful approach, noting where emotions may have impacted decisions. Meaning, mindful trading ensures that every decision is intentional, disciplined, and emotion-free, enhancing consistency, accuracy, and long-term profitability. Habit 50. View trading as a lifelong journey. Successful traders recognize that mastery requires years of learning, practice, and self-improvement. Trading is not a quick path to wealth, but a lifelong journey of continuous growth, strategy refinement, and personal discipline. Example: Warren Buffett has spent decades perfecting his investment philosophy and continues to read, study, and adapt even after 70-plus years in the markets. Similarly, legendary traders like Paul Tudor Jones, Stanley Druckenmiller, and Jim Simons emphasize ongoing learning as essential to sustain success. Implementation: to embrace trading as a lifelong journey. Treat trading as a long-term skill-building endeavor, not a quick profit scheme. Continuously read, study market developments, and refine strategies based on experience and research. View setbacks and losses as learning opportunities, incorporating lessons into future decisions. Periodically review progress, adjusting goals and approaches for ongoing improvement. Meaning, viewing trading as a lifelong journey fosters patience, resilience, and continuous improvement, ensuring sustainable success over time rather than short-term speculative gains. Thank you for visiting our YouTube channel's huge library audiobooks. We have more books about financial, motivation, investing, learn more Forex, trading psychology mindset.